Inflation. It's one of those words that sounds complicated, but quietly shapes almost every part of our daily lives. It's why groceries feel more expensive, why rent keeps going up, and why headlines talk about central banks raising interest rates. But what is inflation really? Why does it happen? And who does it actually help or hurt? Inflation simply means that, on average, prices are rising. When the same amount of money buys fewer goods and services than before, that's inflation. It's not about one product getting expensive. It's about the general price level across the economy moving up. If your morning coffee used to cost $3 and now it's $3.30, that's inflation. If your rent, your groceries, and your movie ticket all go up together, that's inflation too. Over time, the purchasing power of your money, what each dollar can actually buy, goes down. But here's an important detail most people don't realize. A small, steady amount of inflation is not only normal, it's actually considered healthy. Most central banks, like the US Federal Reserve or the European Central Bank, aim for around 2% inflation per year. That number isn't random. It's just enough to encourage spending and investment, but low enough that people can plan for the future with confidence. Think about it. If prices never changed, people might hold on to their money, waiting for the perfect moment to spend it. And if prices were actually falling, a situation called deflation, consumers would delay purchases even longer, expecting things to get cheaper. That kind of mindset can freeze economic activity. Businesses make less money, lay off workers, and the economy spirals downward. So mild inflation keeps money circulating. It keeps businesses producing and people spending. Now, let's dig deeper into why inflation happens. Economists often split it into two broad types: demand pull and cost push inflation. Demand pull inflation happens when there's too much demand chasing too few goods. Imagine a music festival with 1,000 tickets but 10,000 fans who want in. The price of tickets naturally rises because people are willing to pay more to secure a spot. Now, scale that up to an entire economy. When jobs are plentiful, wages are rising, and people feel confident, they spend more. If the supply of goods and services can't increase fast enough to meet that demand, prices rise across the board. That's demand pull inflation, the economy running too hot. On the other hand, cost push inflation happens when the cost of producing goods increases. If the price of oil doubles, it becomes more expensive to transport food, to fly planes, and to ship products. Those higher costs get passed down the chain until consumers are paying more at the register. This kind of inflation can also happen when wages rise quickly. When businesses pay workers more but productivity doesn't increase at the same pace, companies often raise prices to protect profit margins. There's also what economists call built-in inflation, inflation that feeds on itself through expectations. If people expect prices to rise in the future, they ask for higher wages now to keep up. Companies, anticipating higher labor costs, raise their prices in advance, and the cycle continues. Inflation, in this sense, becomes a kind of self-fulfilling prophecy. Then, there's the role of the money supply, one of the most debated causes of inflation. When a central bank prints or creates too much money relative to the goods and services available, prices naturally rise. Imagine a small town with 100 apples for sale and $100 circulating. Each apple costs about $1. But if suddenly there are $200 in the system and still only 100 apples, people can offer to pay more, and prices double. This is often summarized by the old phrase, too much money chasing too few goods. But real economies are more complicated. Money doesn't just appear out of thin air. It moves through lending, credit, government spending, and investments. Sometimes the money supply can grow rapidly without causing inflation, especially if productivity is increasing too. For example, during periods of strong technological innovation, companies can produce more with the same amount of labor. That keeps prices stable even as money expands. So, inflation is rarely caused by a single factor. It's often the result of several forces acting at once: demand growing too quickly, supply chains struggling, production costs rising, and monetary policy interacting with it all. We've seen this many times in history. After World War II, for example, demand for goods surged while factories were still recovering from wartime production. Prices rose sharply. In the 1970s, oil shocks caused cost-push inflation around the world. Gas prices soared, and everything else followed. And most recently, during and after the COVID-19 pandemic, a combination of supply chain disruptions, labor shortages, and massive government stimulus led to the highest inflation rates in decades. Now let's talk about what inflation does and who it affects. Inflation doesn't hit everyone the same way. If you owe money on a fixed-rate loan, inflation can actually work in your favor. Let's say you borrowed $100,000 at a fixed interest rate. As prices and wages rise, you're paying back that loan with money that's worth less than when you borrowed it. Your debt effectively shrinks in real terms. But if you're a saver, it's the opposite story. Inflation erodes the value of money sitting in your bank account. Even if your balance doesn't change, what that money can buy slowly shrinks. A savings account earning 1% interest in a world with 4% inflation is actually losing 3% in purchasing power every year. That's why people often look for assets that can outpace inflation, like stocks, real estate, or commodities. These investments tend to rise in value as prices rise, preserving wealth over time. Inflation also changes how businesses operate. Companies facing higher costs may have to increase prices or reduce production. They might delay new investments, unsure whether customers can still afford their products. Uncertainty rises, and planning becomes harder. That's one reason central banks try so hard to keep inflation predictable. Because unpredictable inflation can destabilize the entire economy. Governments have several tools to manage inflation, but the most important one is interest rates. When inflation gets too high, central banks raise rates to make borrowing more expensive. Higher interest rates cool off demand. People and businesses take fewer loans, spend less, and the economy slows. That helps bring prices back down. But it's a delicate balance. Raise rates too much or too fast, and you risk triggering a recession, where growth stalls and unemployment rises. Raise them too little, and inflation keeps accelerating. It's like steering a huge ship. Every adjustment takes time to show its effect. Sometimes governments also use fiscal tools, like cutting public spending or increasing taxes, to reduce demand in the economy. But those policies are politically unpopular because they can hurt short-term growth. That's why managing inflation is as much a political challenge as it is an economic one. Another interesting layer is that not all inflation is bad. For example, inflation driven by a growing economy, where wages rise and people can afford higher prices, is far less damaging than inflation caused by shortages or crises. Economists sometimes call this good inflation. It reflects strong demand and healthy growth. Bad inflation, on the other hand, often happens when supply collapses or when governments lose control of money creation. The worst-case scenario is hyperinflation, when prices rise uncontrollably. In places like 1920s, Germany, 2000s Zimbabwe, or more recently Venezuela, money lost value so quickly that people needed wheelbarrows of cash just to buy bread. In those moments, trust in the currency itself collapses, and the entire financial system breaks down. Thankfully, hyperinflation is rare. Most modern economies have strong central banks that can respond quickly to early signs of inflation. They monitor price indices, employment rates, consumer spending, and money flows to anticipate trends before they spiral out of control. In the end, inflation is a reflection of balance between what an economy produces, what people demand, and how much money exists to connect the two. It's both a symptom and a signal. A little bit tells us the economy is alive and moving. Too much, and it tells us something's overheated. Inflation affects everything from interest rates to job markets, from your grocery bill to global trade. It shapes how people save, how companies invest, and how governments make decisions. It's the invisible force moving beneath the surface of everyday life, quietly reminding us that money itself only matters because we trust what it can buy. Inflation changes how we live, how we spend, and how we think about the future. Because when prices move, everything else moves with them.